Hello and welcome. This video will discuss the cash flow statement, what it is, why it is needed, and how to understand it. The cash flow statement is one of the SEC mandated reports that every publicly traded company must provide. It, as the name implies, provides investors insight into how cash flows into the company and how the company uses that cash to finance its operations. If you were running a hot dog stand, everything would be simple. You would buy your hot dogs and buns, you would receive immediate cash payment for each hot dog you sold. You would know at the end of the day if you were profitable and if you had more cash than you did that morning. But complex multinational corporations require an elaborate accounting and reporting system to provide the investor an accurate view of the company's operations and financial condition. The statement of cash flows is one of the key reports that provide you insight into a company's financial health. In your hot dog stand, profit and cash flow were identical. However, in the business world, profit and cash flow are often two very different things. Sometimes companies buy and pay for raw materials well before they're converted into finished products, which are later sold to customers on credit. So cash flows out well before the sale, and cash comes back in well after the sale. Sometimes companies buy raw materials or inventories and are able to sell them to customers before they are required to actually pay for the materials or inventory. Many retailers are able to achieve this by purchasing inventories and sell them before they have to pay for the inventory they've already sold to their customers. In these cases, sales and profits occur before the cash moves at all. The accounting profession strives to match up inflows from sales with cash outflows due to the expenses associated with those sales. In doing this, they can more accurately reflect their client company's financial statements. The accounting practice to achieve this is called accrual accounting. This method yields a more accurate disclosure of the company's true operations and financial condition. This is becoming more commonplace because most companies buy and sell on credit. Think of your own home practices. You probably buy things this month using a credit card, but do not actually pay with the cash until the next month, or later, depending on whether you pay off your credit card all at once or over time. The company that sold you the merchandise records the transaction as a sale, but they will not receive cash until later. So, the company's books show a sale, but their cash balance has not changed. The actual cash revenue may not be realized until next month or even next year. Modern accounting recognizes a sale at the time the customer takes possession of the merchandise. Cash may not be received until later, but the sale is recorded and will be reflected as a sale during that accounting period. The amount of that transaction is recorded as a receivable due to the company. Accountants will also include in the same time period the company's expenses associated with that sale, so as to provide an accurate record of the costs associated with that sale. Due to the use of accrual accounting, the income statements a company releases may not accurately illuminate the company's cash position. As an investor, you want to know both. You want to understand their sales and profitability, but you also want insight into the company's cash position. Some profitable companies ceased operations because they ran out of cash and could not meet their financial obligations like payroll, mortgage obligations, tax payments, or even cash to buy raw materials to support their manufacturing operation. Company managers have to carefully manage their cash flows as well as other aspects of the enterprise. As an investor, you want to have insight into the status of the company's cash position and how it flows in and out of the company's coffers. It is possible a growing and profitable company can mismanage its cash flow and jeopardize its financial health. That is why you, the investor, need to study the cash flow statement. This statement gives you insight into how they're doing at managing their cash. The cash flow statement clearly reveals how a company brings in money, cash inflows, and how it spends its money, cash outflows. We've already explained that while accrual accounting provides a method of matching revenues and expenses, it does not reflect if the company has actually received the cash associated with those reported sales. That is the job of the cash flow statement, and it is vitally important for you to understand. Cash flow statements utilize a format that is common to all companies. Once you get the hang of this format, you'll be able to read and comprehend any company's cash flow statement. The good news is that the cash flow statement uses terms that are logical and make sense, like cash inflows and cash outflows. In other words, what is coming in and what is going out. Very simple. Generally speaking, there are three types of cash flows. Cash flows from the operations, from investing activities, and from financial activities. The cash flow statement categorizes all the company's cash flows into these three buckets. Cash flows from operations, as the name implies, includes all cash flows in and out that are generated by the normal operation of the company. These will be a combination of inflows when the operation income exceeds expenses, i.e. a profitable net income. The category will also include cash flows in and out associated with the depreciation expense, changes in account receivables, inventories, and other operational related activities. Depreciation, the write-off of capital investment over time, is considered a cash inflow because depreciation is treated as an expense against operating income and therefore is added back when calculating cash flows. Cash flows from investing activities include cash outflows from capital equipment purchases and cash in or out from the investments the company makes. While capital equipment, such as a building or a machinery, is used in the operation of a company, it is not consumed during the operations. It is an investment and is categorized as such on the cash flow statement. Cash flows from financing activities, as the name implies, are the cash inflows and outflows generated by financing activities such as dividends paid out to stockholders, the sale or purchase of stock, net borrowing, and any other cash flow not related to normal business operations or investments. You will see these three groups of cash flows on any cash flow statement. At a glance, you'll see if the corporation is overall generating or consuming cash, and how are those cash flows being generated. The most important of these three is the net cash flow from operations. This is the amount generated from operations netted against the cash outflows associated with operations. This clearly demonstrates if the company's operations are getting a positive cash flow. Analysts and investors often express net cash flow from operations as a percentage of net sales to ascertain how the cash flow is tracking with sales. An efficient company will show a stable or growing percentage, indicating that cash flow is being maintained consistent with sales growth. If the percentage is declining, it is a red flag to investigate further to understand what is causing this. It may not be a problem, but a prudent investor investigates to understand why this is occurring. Another common analytical measure is to monitor free cash flow. This is net cash flow from operations less capital expenditures. A highly attractive investment will show a steady and growing free cash flow. Remember, the whole idea behind the cash flow statement is to provide insight into how effectively the company is managing their cash. If they run short, they'll have to go to the expense of borrowing or selling stock, which dilutes ownership of existing shareholders and will reduce earnings per share. This usually leads to a reduced stock share price. A business is a financial organism that is all about cash. It engages in activities to generate cash. It engages in activities that consume cash. The cash flow statement is your insight into how these activities compare, trend, and how they result in long-term financial health of the company, and therefore, your investment. Let's examine a typical corporation's cash flow statement. So how does business X look from a cash flow perspective? Actually, it is very healthy. Net income is increasing steadily. Net cash flow from operations is also rising, and is increasing as a percentage of net sales indicate management is being diligent in controlling expenditures during this environment of growth. Free cash flow, which is net cash flow from operations less capital expenditures, increased nicely during the last 12-month period, another show of positive momentum. Management is increasing capital expenditures as sales and net income rises, but is controlling overall expenses to enable free cash flow to maintain very healthy levels. Another healthy sign is how Business X has improved its cash flows from financial activities. Its financing activities consumed cash in 2010 and 2011, perhaps to finance growth related to resources. But in 2012, this cash flow reversed from negative to positive, which translated to a very strong change in the corporation's overall cash position. This cash flow statement was an abbreviated version. The one you'll see published by real-world companies will show more detail. That detail will enable you and other investor analysts to better understand the cash flows happening within each of the three cash flow categories. We hope this video has given you an appreciation for the cash flow statement, what it is, why it's important, and has given you a comfort in understanding how to read it. We wish you much success as you gain skills in planning, research, and managing your investments.